Welcome to the NiftyNoon podcast. Imagine a single entity, right, just quietly moving over $1 billion in the financial shadows, all while everyday retail investors are, absolutely panicking over red numbers on their screens.
Yeah, it's a wild mental image.
It really is. Today, we are bringing you a deep dive into the daily dispatches from our newsletter, tracking what can only be described as a totally chaotic week across crypto, finance, and tech.
Truly chaotic.
Right. We're going to be breaking down the timeline from May 26th to May 29th, 2026. And our mission here is simple. We want to help you make sense of these massive structural shifts by tracing the cause and effect of the market day by day.
Yeah, because it was an incredibly dense week for anyone reading the daily dispatches. But, when you filter out all the noise, you start to see a very clear through line. We essentially saw three dominant themes collide. First, a major clash of ecosystem models. So we have legacy giants like Ethereum facing a legitimate identity crisis, while hyper-efficient upstarts like Hyperliquid are basically rewriting the rules of decentralized finance entirely.
Completely rewriting them, yeah.
And then second, we have these wild institutional paradoxes. You mentioned that billion-dollar shadow trade earlier. We are seeing massive ETF outflows on the surface that are actually masking incredible accumulation behind the scenes.
Right.
And third, the week culminated in a looming political showdown over America's digital asset future.
So let's jump right into the start of the week. Because before we look at where the market is trying to go, we really need to look at the giants that are stumbling right now. The Monday, May 26th dispatch from our newsletter reported a massive vibe check hitting the Ethereum ecosystem.
Oh, massive.
We're talking about a serious brain drain. 9 senior operators have left the Ethereum Foundation in 2026 alone. And these aren't just, junior devs jumping ship.
Definitely not.
We're talking about heavyweights, people like Tim Bako and Josh Stark.
Right, and when you lose the core architects of your system, the broader community naturally starts questioning the blueprint. The sharpest critique we covered came from veteran crypto journalist Laura Shin. She argued that Ethereum's original sin, so to speak, was completely ignoring its tokenomics after the Denkin upgrade.
Okay, let's actually unpack the mechanics of that for a second. Because on paper, the Denkin upgrade was supposed to be this huge win for the network.
It was billed as the ultimate scaling solution,
Right. It aggressively lowered fees on Layer 2 networks, making it insanely cheap for everyday users to transact. But the downstream effect is what really caught people off guard. Lowering those fees essentially crippled the ultrasound money narrative.
Yeah, and to understand why it crippled that narrative, you have to look at how Ethereum's underlying economic engine actually works.
Right.
Historically, the network relied on high transaction fees because a portion of every single base fee gets burned, meaning it is permanently destroyed.
Right, taking it out of circulation.
Exactly. That burn mechanism is what made ETH a deflationary asset, which is obviously highly attractive to long-term holders. But when the Denkin upgrade slashed those transaction fees, well, the burn rate just plummeted right alongside it.
Yeah.
Suddenly, the economic mechanism that gave ETH its premium status was completely neutralized.
It created a total vacuum of purpose. And, into that vacuum, you have former Ethereum Foundation researcher Dangrad Feist stepping up with a proposal that is, it's ruffling a lot of feathers.
Oh, for sure.
He's calling for the creation of a completely new, economically aligned entity armed with a $1 billion treasury. His argument is basically that Ethereum needs to prioritize aggressive network growth and competitive market share over maintaining this pure cypherpunk ideology.
Because ideology doesn't pay the bills when you're competing in a mature financial market.
No, it doesn't.
The shift away from focusing on tokenomics is really forcing the Ethereum community to look in the mirror. They have to decide if they're building a public good, like the basic protocols of the internet where profitability simply doesn't matter, or if they are a highly competitive financial network that needs to actively fight to retain capital.
This feels like a classic tech giant innovator's dilemma.
Oh, totally.
It's like watching early Silicon Valley idealists suddenly realizing they have to act like a ruthless Fortune 500 company just to survive. Like, they don't want to wear suits, but the market is demanding a boardroom strategy.
That's exactly what it is.
And this philosophical crisis is manifesting directly on the charts. If you look at the technical data we highlighted in the newsletter, ETH is currently consolidating in a very tight, triangle-shaped, bearish pennant pattern right near the $2,130 mark.
Which is a very precarious place to be. I
Right.
mean, if the price breaks below that $2,130 support line, the technical models suggest we could see ETH slide all the way down to the $800 and $900 zone. Well, yeah. Conversely, if the broader market turns risk on and pushes ETH above the resistance at around $2,460, it could invalidate the bearish setup entirely. But it's teetering on a nice edge right now. They really don't have the luxury of time to sit around and debate their soul.
Especially because the rest of the market isn't waiting for them to figure it out. While Ethereum is bogged down in philosophical debates on Monday, the upstarts are moving at light speed.
Relentlessly.
Yeah. By Tuesday, May 27th, the contrast in our newsletter was just glaring. Highly efficient protocols are ruthlessly executing these top-down product strategies to steal market share. Which brings us to the Hyperliquid update.
Right, so Hyperliquid rolled out their massive HIP-4 update, and it is a fascinating technological leap. They launched validator-governed prediction markets for real-world events.
Yeah.
So you can bet on things like upcoming inflation data or Federal Reserve interest rate decisions. But the real story is how they are doing it. They are completely eliminating the need for external oracles.
Let's define the oracle problem for a second, for anyone who might not be in the weeds on this. If you and I place a bet on a blockchain about who wins the Super Bowl, the blockchain itself doesn't have eyes.
Right, it doesn't know what's happening outside its own code.
Exactly. It doesn't watch TV. It needs an outside data source, an oracle, to report the final score so the smart contract knows who to pay out. Rivals like Polymarket, which, by the way, was also in the news because Spain decided to block them, and Kalshi, they rely on external oracle networks like UMA to verify real-world outcomes.
But Hyperliquid just brought that entire process in-house. They are using automated newsfeed software so that their own native validators become the oracle.
Wow.
And keep in mind, these are the exact same 24 validators that are signing blocks every 70 milliseconds and securing over $3 billion in user deposits. They are now deploying and settling the markets themselves.
This turns Hyperliquid into what people are calling the everything venue. Like, a trader doesn't need 10 different tabs open anymore. They can manage their crypto perpetuals basically betting on future prices without an expiration date, right alongside pre-IPO contracts and macro bets on global events. And they can do it all out of a single cross-collateralized account.
Yeah.
Meaning, you can use your Bitcoin to back up a bet on inflation.
It is vertical integration at its absolute most extreme.
Hold on, though. Here's where it gets really interesting, but also a bit sketchy.
Okay.
If the validators are basically checking their own homework, aren't we just recreating the central banking system? Like, if a tiny group of 24 validators controls the data and the settlement, that feels like a massive centralization risk. Why are traditional financial institutions suddenly on high alert over this if it's philosophically so risky?
Well, you're absolutely right to be skeptical, and the centralization of risk is a very real debate right now. But a recent market report from FalconX that we highlighted in the newsletter gets to the core of why traditional finance cares so much.
Okay.
Legacy venues aren't looking at this as a philosophical failure. They are looking at it as a terrifyingly efficient competitor.
Ah, I see.
Yeah, this level of vertical integration offers unprecedented capital efficiency. You don't have your money fragmented across different chains. And you aren't waiting days for third-party Oracle dispute windows to close. It is instantaneous. Because of the 70 millisecond block times, it ceases to be just a crypto casino. It becomes this multi-asset vortex that can aggressively suck in capital from traditional markets.
Wow, yeah. And we saw other examples of friction being removed from the broader ecosystem on Tuesday, too. Pump.Fun launched a mobile app update for frictionless multi-chain trading. The overarching theme of the day was just relentless, optimized execution across the board.
Yeah, though before we move off Tuesday's dispatch entirely, I do want to step away from the charts and the tech for a second. We reported some really somber news regarding Ondo Finance.
Yes. The unexpected passing of their founder, Nathan Ullman. The community poured out an incredible amount of support, remembering his brilliance and his humility. And, when we get so wrapped up in block times and tokenomics, it's just a stark reminder of the human element in all of this. The people building this infrastructure are what actually make the entire ecosystem possible.
It's such an important perspective to keep.
Yeah.
Because, no matter how brilliant the tech is, it doesn't exist in a vacuum, which became painfully obvious when we look at the massive bleeding we saw in the markets by Wednesday.
Right. So we have hyper-efficient tech being built on Monday and Tuesday, but by Wednesday, May 28th, we see that no technology can escape macro gravity.
Macrogravity always wins.
It does. The headline that absolutely dominated by fear was a brutal 7-day negative outflow streak for U.S. spot Bitcoin ETFs. We are talking about over $1.88 billion bleeding out of these funds, largely led by BlackRock's IBIT. And Bitcoin's price softened down to the $74,000 to $75,000 range as a result.
Right. And it's crucial to understand this had absolutely nothing to do with a failure of Bitcoin's technology or the underlying network. This was pure macroeconomic anxiety.
Yeah.
The Federal Reserve has been heavily signaling a higher for longer interest rate environment. And when the cost of capital stays high, large-scale allocators start tactically de-risking. They rotate their capital out of risk assets like crypto and into traditional equities, or they just chase the momentum in the AI sector.
But here is the plot twist of the week. This is the big aha moment from the newsletter. Amidst all of those terrifying red outflow numbers that everyday retail investors were obsessing over, something massive happened in the shadows.
The dark pool trade.
Yes. There was a single block trade of 29.2 million BlackRock IBIT shares. That is $1.29 billion, executed entirely privately through a dark pool. So wait, a single entity quietly moving over $1 billion in a dark pool while retail sees red outflows. What does this all mean for the everyday listener? Like, should they be panicking?
Well, if we connect this to the bigger picture, the answer is no, you shouldn't be panicking. This is why you have to look beyond the surface headlines. A dark pool is a private financial forum or exchange for trading securities. They exist precisely so. Massive institutional investors can execute gigantic trades without immediately exposing their intentions to the public market.
Right, because if you try to buy or sell over $1 billion of an asset on an open public exchange, the high-frequency trading algorithms see it coming from a mile away.
Oh yeah, they front run you immediately.
Exactly. The price moves against you before your trade even finishes, which is called slippage. It's like trying to quietly sell a $1 billion mansion by standing on your front lawn with a megaphone.
Right. It's a terrible strategy. Dark pools prevent that kind of market panic. So this dark pool trade is actually a highly constructive sign.
Really?
Yeah. The fact that the Bitcoin market was able to absorb a $1.29 billion single trade without causing a catastrophic double-digit percentage price crash proves something we couldn't say even a couple of years ago. Bitcoin now has true institutional-grade depth. The plumbing actually works. It is acting like a mature macro asset weathering cyclical volatility rather than just a fragile speculative bubble.
That makes a lot of sense. And we saw signs of that institutional momentum elsewhere on Wednesday, too. MasterCard was officially granted a BIT license by the New York State Department of Financial Services.
A huge regulatory milestone.
Yeah, and tying back to our earlier discussion about Tuesday, the Bitwise Hyperliquid ETF ticker BHYP saw a massive $19 million inflow in a single day. So the big money is still aggressively building out the infrastructure.
Absolutely. And, if institutions are quietly anchoring their billion-dollar positions in the shadows, the final piece of the puzzle is establishing the legal rules of the game in the light. You can't build a global financial system on regulatory ambiguity.
No, you definitely can't.
Which brings us to the political bombshells on Thursday, May 29th.
The political end game. Our newsletter covered some incredibly aggressive rhetoric coming out of Washington. President Trump took to Truth Social with a very explicit promise to codify a future-proof digital asset market structure.
Right.
He stated that this structure needs to be built so it can't be undone by what he called crypto haters, and he specifically targeted SEC Chair Gary Gensler.
The stated goal of the administration, which was echoed by the Senate Banking Committee GOP, is to establish the United States as the definitive global capital for digital assets. And we are already seeing companies position themselves for this potential shift, like HIV Digital Technologies recently relocated their operations to Texas to capitalize on what they perceive as friendly domestic jurisdictions.
Now, we need to be very clear with you here. As we look at the political landscape outlined in our newsletter, we are strictly analyzing the factual legislative hurdles and the market implications. We aren't taking any political sides, and we aren't endorsing any candidates. We are just looking at the cold, hard math of how a bill becomes a law in Washington. Because translating executive rhetoric on social media into lasting codified law is an incredibly complex uphill battle.
Yeah, and the primary legislative vehicle being discussed right now is the Clarity Act. Yes, it recently advanced through the Senate Banking Committee, which is a significant milestone, But analysts point out that this is barely the beginning of the marathon.
Right. To actually become law, the Clarity Act has to be merged with a parallel bill coming out of the Senate Agriculture Committee. And those two committees have historically hated sharing jurisdiction.
Oh, it's a massive turf war.
Yeah, they have very different views on who should regulate what, which really boils down to the endless fight between the SEC and the CFTC over whether certain digital assets are classified as securities or commodities.
And even if they manage to merge those bills perfectly without watering down the language, which is a big finick, and it still has to hit a 60-vote filibuster threshold on the Senate floor. That means it absolutely requires bipartisan support. You need substantial Democratic buy-in to pass it. The party cannot force it through alone. Furthermore, the newsletter noted that this progress is facing very real legislative headwinds right now due to conflict of interest concerns.
Yes.
Lawmakers are raising questions regarding the Trump family's own involvement in decentralized finance projects, specifically the World Liberty Financial Project.
So the rhetoric is incredibly bullish, right? But the actual math in Washington, getting those 60 votes, means we are still a long way from the finish line.
A very long way.
The market is basically holding its breath, waiting for actual rules of the road before the next major wave of institutional adoption can truly begin.
Yeah. When you zoom out and look at this entire week, from the ecosystem clashes to the political battles, it's vital to separate the noise from the signal.
Okay, so break that down for us. What was the noise this week?
Honestly, the 7-day ETF outflow streak. It feels terrible when you see it isolated in a headline, but it's just standard macro rotation driven by Fed interest rate expectations. It is entirely overshadowed by the massive billion-dollar dark pool liquidity that is quietly anchoring the asset class.
Okay, so if the outflows are the noise, what was the real signal for the listener to take away?
The true signal is the structural shift in how these networks are operating. We are watching legacy systems like Ethereum being forced to radically rethink their fundamental economic models and decide what kind of network they actually want to be moving forward.
Right.
And simultaneously, we are seeing integrated systems like Hyperliquid, proving that, at the end of the day, capital flows to efficiency. The sheer speed and vertical integration of their validator Oracle model is what will drive the next wave of innovation.
As for what to watch next, definitely keep your eyes on that $2,130 support line for Ethereum. If the technicals break down there, it could get really ugly for altcoins. And politically, keep watching the mechanics of the Senate to see if the Clarity Act can actually secure those 60 votes to survive the gauntlet.
It's going to be a fascinating few months as these three themes about it: the ecosystem wars, the institutional paradoxes, and the political showdown continue to evolve.
It really is. And I want to leave you with one final thought to chew on as we wrap up today's deep dive. We spent a lot of time talking about Hyperliquid turning their own validators into news oracles to settle bets on real-world events. Well, if the financial infrastructure itself is now pulling in real-world data at 70 milliseconds to verify reality and settle billions of dollars, are we looking at a future where blockchains don't just react to the global news cycle, but actually become the most trusted way we verify the news itself?
Got a wild concept to think about.
It really is. Thank you so much for joining us on this deep dive. If you want these kinds of insights and tracking delivered to you daily so you can stay ahead of the curve, make sure you follow NiftyNoon on X and subscribe to the NiftyNoon Substack. We'll see you next time.